Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from the SALT Conference in New York City. Joining me for this segment, we have Sona Menon. She is the partner and outsourced CEO at Cambridge Associates. We're here to discuss the factors that are driving growing demand for outsourced Chief Investment Officer services. Sona, it's great to have you with us. Welcome to TradeTalks. Give us a brief overview of Cambridge, the type of clients that you're working with, and what's your role at Cambridge?
Yeah, so Cambridge is a global investment firm, and we build portfolios for institutional clients like endowments and foundations and pensions and family offices. We have about 700 billion assets under advisement, and of that, about 75 billion is fully outsourced. And my role at Cambridge is as one of the outsourced CIOs, so I'm building portfolios for these institutional clients.
Yes, I was just going to ask you, what is an outsourced CIO, and what are the factors that are driving growing demand for that type of role?
Yeah, so outsourced CIO is essentially when organizations decide to outsource the investment strategy and oversight, daily oversight and implementation of their portfolio to someone like us, who essentially it works for them, but sits inside of Cambridge Associates.
Right. What's driving the growing demand for that? And then the second part to the question is, when you think about your portfolio construction process, is it a one-size-fits-all for the different clients you're working with, or do you right-size it for different needs for different clients?
Yeah, so a lot of reasons why this area is in growth mode. First of all, markets are only getting more and more complex. Mm-hmm. And there are so many different asset classes to invest in. There's equities, there's bonds, there's alternative assets, hedge funds, private equity, venture capital, et cetera. And many organizations aren't equipped to make the investment decisions on all these asset classes and find the right funds, and they may not have the resources with which to identify the best-in-class investments. So, the complexity itself leads people to outsource. And another reason is essentially governance, right? So many organizations, they have other things that are going on in there, and they don't have the time to essentially oversee the portfolio and make decisions on a timely basis. So particularly when there's a market dislocation, et cetera, they can't react as quickly because they don't have the resources, the people resources, and the time resources to make those decisions. Those are just some of the reasons why we're seeing a lot more growth in outsourced CIO, because people want someone else to essentially build the strategy, implement the strategy, and oversee the strategy.
Right. It's not just quite as simple as picking a basket of stocks and you set it and forget it. I mean, there's actually the practice of portfolio management. So when you're constructing portfolios for different types of clients, do you have different strategies for different types of clients and their needs and their thematics?
Absolutely. I mean, like I said, we work with endowments and foundations. Mm-hmm. We work with healthcare institutions. We work with family offices and pension plans. They all have unique objectives. Right. So the first and foremost is we want to try to understand the very specific objectives of their portfolio, what they're driving for, what they're solving for, what their constraints are. I mean, they could be risk-oriented constraints, they could be liquidity-oriented constraints. So we would want to build a portfolio that reflects those objectives, and then we'd want to sort of tailor the investments underneath, right? So everyone's asset allocation strategy is different, and then the investments we put in there are also different. So I would say no two portfolios look alike, and it's absolutely not set it and forget it, because once I actually find the ideas that I put in the portfolio, then I have to monitor them, manage them, and reallocate capital as and when markets move and opportunities develop.
What are the asset classes that you find compelling right now in today's environment?
So because we work with long-term institutions, we will tend to use a lot of alternative assets in our portfolios. But I would say, so two things I would note very much. I think hedge funds have been out of favor for quite some time. And I think that that's a mistake. I think there's some really interesting things that make hedge funds particularly interesting right now. With interest rates rising, I think long-short hedge funds can make money on their short rebate. Also, markets are complex. There's a lot of geopolitical risk, and so there's going to be a lot of winners and there's going to be a lot of losers. And very skilled hedge fund managers can navigate through that uncertainty really, really well. Last thing I would say is, on the hedge fund side, is that because they've been out of favor, some of those very hard to access investments are now accessible. So I would say those are places that I find particularly interesting. Secondly, I'd say we've always been investors in venture and private equity. Right. And that space obviously, has been frothy, you could argue, after 2021 and 2022 in the bubble burst. Things have been a little softer, but I would say that actually makes it a little bit more interesting now. And net, it's a long-term game, as you know, with private equity and venture. So I'm actually increasing allocations to that space for my clients.
What are some of your macro expectations for the remainder of 2024, and how can LPs prepare for future market volatility?
Well, I think that there's a lot of headwinds right now. I think geopolitical risk is one of them. I think stubborn inflation is one of them. There's a lot of concentration in public equity markets with the Mag 7 effect. So, things are not easy in markets. So in my role as an outsourced CIO, I want to basically play good defense and smart offense. So in terms of smart offense, I continue to believe in, leaning into growth and equities. Growth has been, when I say growth, I meant growth-oriented investments, but between value and growth, value has suffered quite a bit.
Right.
So I'm actually leaning a little bit into value, like bottom decile, so you can't really ignore them. That could be a good sort of tactical play. And like I said, hedge funds, long-short hedge funds are really interesting for. So these are all sort of good offense. In terms of good defense, I would say, long-dated bonds, treasuries. You've seen one of the biggest market sell-offs given the rising rate environment. And bonds are cheaper than ever. So if you're going to play offense, you also want to play defense on the other side. And so I've been also adding to my long bond exposure. And as I mentioned, I work with a lot of corporate pensions. So we have a lot of long credit exposure for them. Spreads are very, very tight.
Right.
So I'm actually leaning a little bit into the intermediate part of the curve and investing in intermediate credit as a little bit of a hedge. So those are sort of my defensive strategies.
All right, Sona, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from SALT. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.